Mark didn't gamble. He didn't day trade. He didn't buy meme stocks. He didn't touch crypto. He did what every responsible investor is told to do. He diversified. And still, in less than 6 months, he watched $250,000 disappear. Not because he was reckless, but because he misunderstood one word: diversification. Mark is 42. He works in corporate finance, good income, disciplined, maxes out his 401k every year. He listens to market podcasts on his commute, reads about the Fed, knows what inflation means. He's not careless, he's careful. That's what makes this interesting. If you looked at his portfolio, it felt solid. An S&P 500 ETF, some tech stocks, a growth fund, international exposure, a few dividend payers, 5 buckets, different names, different charts, different logos. It looked diversified. It felt diversified. But structure matters more than labels. And structurally, Mark owned the same bet 5 times. Then inflation stayed high longer than expected. The Fed didn't pivot. Rates remained elevated. Tech started slipping. Normal correction, he told himself. Then the S&P followed. Then international markets dipped. Then growth stocks accelerated downward. Suddenly everything in his diversified portfolio was red. Not different shades of red, the same red. At first it was manageable, -8%, then -14%, then -22%. He refreshed his retirement account one evening and just stared at the screen. The number wasn't catastrophic, but it felt different. It felt fragile, because for the first time he realized something. Everything he owned depended on the same outcome: growth, liquidity, optimism. Here's the uncomfortable truth. Owning 5 equity-based funds is not diversification. It's concentration in disguise. Different tickers don't equal different risks. If the same macro force can hit all of them at once, you're not spread out, you're stacked. In strong bull markets, that feels smart. In tightening cycles, it feels exposed. Mark didn't panic at the bottom, but he got uncomfortable enough to second guess. He delayed new contributions, considered shifting everything to cash, started checking markets more often. Diversification didn't fail mathematically, it failed emotionally, because true diversification reduces volatility, and reduced volatility protects decision-making. Real diversification isn't about quantity, it's about independence. Assets that respond differently to interest rate changes, inflation shifts, liquidity tightening, economic slowdowns that might mean combining equities with short-duration bonds, treasury exposure, defensive sectors, even some cash allocation. Not because cash is exciting, but because stability buys clarity, and clarity protects capital. Markets don't usually destroy wealth overnight. Behavior does. When portfolios swing too aggressively, emotions follow. And emotions are expensive. Mark didn't lose everything. He didn't ruin his retirement. But he learned something most investors learn the hard way. Diversification isn't about how many things you own. It's about how differently they behave when stress hits. If your entire portfolio depends on one economic outcome, you're not diversified. You're optimistic. And optimism works until it doesn't. The calm investor doesn't avoid risk. He structures it. Because when the next storm comes, you won't care how many funds you own. You'll care how they move.